Hey, welcome to the show. I'm Mitch Goldberg. Welcome to Be the Boss of Your Money. I want to talk to you about a topic we don't really talk about a whole heck of a lot here, but it's about hedging. And what sparked the interest in this topic for me is, well, you asked. It's popular enough of a title of an article, of an idea to be an article, and I've seen this before. And every now and then I see articles pop up about hedging and who's selling you these hedges. What do you use to hedge a portfolio? Should you even bother wasting, or should it be considered a waste of time and effort and money to hedge a portfolio? So that's what we'll talk about. We'll do a quick market update as well. So let's roll a quick intro and stick around. It's going to be a good show. Interesting stuff we don't usually talk about. All right, thank you for joining me. Let's just take it to the screen, pop myself up in the corner here. The Dow up 66, little bit of a gainer. Okay, nothing major. We are really focused on that 40,000 figure, which we've been at already, but right on the cusp of retaking that number. But we did it already. So now it's kind of like a buzzkill and a little pause, which is normal. And we'll see what happens next. NASDAQ and S&P 500 were both up. They both set new records today. So those are at record highs. A number of strategists, Wall Street firms have raised their year-end targets and their new, let's say, one-year out targets for the S&P. And I'm seeing numbers like 5,500 to 5,700. By the way, you cannot invest directly into an index, but you could invest into a security that tracks or mimics an index. Don't you know? All right. Good news there. Okay. Gold down 13, but hanging around 2,400. I just want to know what's going on with gold. Don't you? Like, if we knew exactly what's going on with the yellow metal, we'd all be doing it, but we'll see. I've been talking about gold for years, and finally it's doing something, but I don't think it's done. In my opinion, I have stocks. I have gold, and my stocks have trounced gold by miles. Oil remains under $80 a barrel. That's interesting because so many people predicted that oil would go through the roof. We had that volley of bombs and rockets and drones with between Israel and Iran. They did their thing. They stopped Iran's pretty much broadcasted bombing, when they basically said the weapons and the flight paths of what they're going to be, sent them over to Israel, and then Israel retaliated. And that was the end of that. And things all of a sudden got quiet there. So oil never really took off. And you know what? The oil market is very different than it used to be. So we have our oil here. We don't really need foreign oil anymore. It's a bigger problem for the Chinese if there's political or geopolitical strife in the Middle East than it is for us as far as oil goes. Much bigger problem for China. So not so worried about oil. And I've said that before. We don't like to chase these kinds of investments when there are geopolitical events, because often what happens is leading up to the geopolitical event, safety trades, which I don't think are so safe, like gold and oil, typically run up in advance and on anticipation of a big bad geopolitical event, and then they back off right after. There is plenty of oil to be had. I know people are saying, well, there was a big release of oil there were two big releases of oil from the Strategic Petroleum Reserve, one under President Trump, one under President Biden. What about that? See, the Strategic Petroleum Reserve was conceptualized and created when, at a time when the U.S. was producing only about 4 million barrels a day of oil, and we were very dependent on foreign oil. That's no longer the case. We produce our own oil more than enough. So we don't really need such a big strategic petroleum reserve. So people say, oh my goodness, the SPR, it's not really needed that much anymore. I'm not really sure why we even have to this extent anymore. I'm not saying we shouldn't have any, but it is not really necessary because of fracking. VIX is a little bit lower, down to the 11s, continues to go down. Oh, the 10-year yield at 4.4, which is pretty steady, Eddie. It's been 4.3, 4.5 for 4.3% to 4.5% for a while. Let's talk about this. I saw this article today. Charts show a little fear of a market drawdown, so now may be a good time to hedge. But more importantly, if you go back to this, the VIX, it is pretty low, and some would say it is in not worry territory or complacency territory. So let's just talk about that real quick, about hedging one's portfolio. There's so much to say, but basically hedging is when you do something to protect the value of your investment portfolio from going down, or at least putting it in a position of your investment so that if the market goes down, the stock market goes down, your portfolio either wouldn't go down or wouldn't go down as much. And there are lots of ways to hedge. Some of them I think are worth it. Some of them are a little bit more sophisticated. And I think overall hedging your portfolio, in my opinion, for us investors, I'm not talking about hedge funds or institutional accounts or that sort of thing, but for us, people like you and me, hedging is a waste of time. You can use options, you can use long short strategies to hedge your portfolio. I think investors have gotten much smarter about buying this stuff. Back in the 90s and let's say 2000 to 2010, there were a lot of investment products that came out with hedges, principal protection funds, or the long short funds, market neutral funds. And after all is said and done, these investments have had a pretty crummy track record. They didn't deliver well in up markets. They were maybe at best. They were so-so in down markets. And investors would have just been better off investing for the long term and not worrying about what the stock market does over the short term. So if you need to hedge, you might just be someone who is over your skis in terms of risk management. Maybe you're just taking too much risk. So let's talk about hedging. One thing you could do is you could diversify between stocks, bonds, and cash, as opposed to being 100% in stocks. For example, this is a very basic, broad strokes example. Now, diversification is a strategy that we use to mitigate risk, but it doesn't necessarily protect your portfolio from a generally down market. So let's say if you diversify, maybe you have 60% of your portfolio in stocks, 30% in fixed income, and 10% cash. So if the market goes down, the fixed income and cash act as a ballast or a support mechanism for your overall portfolio. And if the market goes up, well, your bonds and cash might not move. Cash probably won't move unless you're getting interest on it. Bonds, it depends on the situation of interest rates, but your stocks could go up a lot. So you could still make money in the market. But when you hedge or diversify, you are giving up upside return for the long term to protect against downside market risk over the short term. Now, when does it pay to diversify? Well, I think some of us could say it always does, and I tend to agree with that. But there's many ways to diversify. You could be 100% invested in the stock market, but still be diversified with different kinds of stocks, from small cap to mid cap to large cap type companies, from technology to healthcare to financials, et cetera, materials, et cetera. And that's one way to diversify also. So not just within the stock market, but between different sectors. Okay. Lots of ways to diversify. It depends on what kind of investor you are. And this is why I always say personal finance is personal. It's different for everyone. But having said that, To me, diversification between stocks, bonds, and cash is a matter of age. More specifically, it's a matter of when are you going to need your money. Now, you could be 50 and you might want to retire at the age of 50. So when you're 55, you really need to start scaling back on some of that risk, but not too much because, 60 is still pretty young and you could have 30 years in a retirement, maybe more. So you still would want to hold on to a healthy portion of stocks. Still, you might want to be 50 to 70% in stocks because you're young. Now, if you're 80, you probably don't need much in stocks because your lifespan isn't going to be that long, unfortunately, not like a 60-year-old. This is just facts, folks. So we're just living in reality. So you don't really need to take as much risk. So you'd be scaled down to maybe 20, 30, 40% stock or even less. It could also depend on how much money you have, how badly you need this money in the next few years. And maybe you just want to leave all that money to future generations, which means you could take more risk with that money. You see what I'm saying here? So there's no cut and dry of how much you should have in stocks, bonds, and cash strictly based on your age. I think it's a good starting point, but from there, it's a jumping off point, and we don't just say, if you're this age and you should be in this much stocks, bonds, and cash. It depends on your overall situation. Maybe you're still in a business that's still throwing off cash flow, so you can be more aggressive with your investments. You see? So another way to diversify another way to hedge is to use limit orders. So maybe you want to keep some cash on the sideline in your portfolio and put limit orders to buy stocks at lower prices. So if stocks do go down, you have the opportunity, the potential opportunity to pick up stocks at lower prices because the stocks might never go down to those prices. And another way to hedge could be using certain derivatives like options. Now, this is where it gets dicey, and I don't like to get into it too much into a live stream, but if you want to talk about options specifically, I have to send you the options disclosure document and then we'll get into it. But having said that, options, there is a cost to either writing covered calls or buying options outright. There is a cost to that. So like I said, hedging is not too different than diversifying. It's a way of giving up some upside to protect against some downside. How much downside you want to protect from determines how much upside you're going to give up. There's no two ways around it. There's no getting around it. There's no getting around that. So this is why I think for most of us, as we age, as we get closer to needing our investments, we start to get more conservative with our portfolio. And that to me is the way that makes sense for the overwhelming majority of people out there, certainly from my clientele. I have found that hedging or market timing, trying to buy and sell based on market peaks, I have found that those have been ineffective, and I think research has borne this out. So to me, my form of hedging is if you're worried about the stock market and you're just too aggressive, you're investing too aggressively for your risk tolerance, you scale it back and get your portfolio down to a risk metric that is more in line with you. Now, if you want to know what your risk number should be, for example, on a scale of 0 to 100, with 0 is no risk, 100 is being very, very aggressive, you let me know and I will send you a risk assessment questionnaire that will actually give you your specific risk number, not just a generalization of, a scale of 1 to 5, but a real risk number for you that we could work with. It's yours. There's no obligation. I do need your email address, though, to send it to you. But I'm not going to put you on my email list, and I'm not going to chase you down, okay? So that's about it for today's show. I hope you will take me up on the risk metric analysis. Have yourselves a lovely rest of the day. Speak to you tomorrow. Oh, by the way, I didn't even talk about this. NVIDIA's earnings are coming out tomorrow. That should be a blast, and everything's going to be riding on that for the rest of the week. Have a nice day.